So if you didn't pass far, it's probably because they gave you a basic question like this and you didn't know what to do. And this question's about investments, and it requires you to know the difference between the equity method and the fair value through net income method. So stop right there and ask yourself if you know the difference between those two methods when you invest in equity securities of another company. So if your company buys shares of stock in another company, when do you use the fair value through net income method? When do you use the equity method? You use the fair value through net income method if you're just a small time investor. You own a few percentage points of the other company. You use the equity method if you were like a 20% to 50% owner of the other company. Then you'd use the equity method because now you have some serious equity in that other company. Which is the one where you pick up their income on your income statement? That would be the equity method. Which is the one where the dividends that you get would be considered income? That would be the fair value through net income method. Because what do you do with dividends under the equity method? You reduce the investment account. That's right, the investment account will go down for dividends received under the equity method. Under the fair value through net income method, you don't change the value of the investment account for the dividends that you get. When do you change the value of the investment account under the fair value through net income method? Under the fair value through net income method, you mark to market at year end. So if the value of their stock goes up, you change the value of your investment if you're using the fair value through net income method. So now let's look at the facts. It says Hook Corp purchases shares in Slice Corp for $500,000 in August of year one. By December 31st, year one, the value of the shares have increased. Okay, so the stock went up in value. Hook Corp would increase the investment account for the change in market price of Slice Corp stock if Hook Corp was accounting for the investment in Slice using the, not the equity method, but the fair value through net income method. That's the one where you would mark to market. Roman numeral 1 is correct. Let's go with letter A. Do we mark to market under the equity method? No. How about number 2 now? It says determine the impairment loss under U.S. GAAP for the year. All right, what do you know about impairment losses? Well, you buy an asset and you determine at year end it's not worth as much as you're carrying it on the books for. So then you have to write it down with a loss. So let's look at the facts. Belt Corp has a machine with a historical cost of $200,000. The carrying amount at year end is $180,000. Why? Because of depreciation, I guess, right? You bought it for $200,000 and the carrying amount in the books, the book value, is $180,000 at year end. So book value and carrying value, same thing. Make a note of it. Book value and carrying amount at year end is exactly the same, $180,000. But the cost was $200,000. Why? Depreciation. At year end, the undiscounted cash flows were determined to be $150,000. What does that mean? Well, that means if you waited until you got your last dollar of cash flow from this machine, you'd get $150,000, whenever that is. It could be 5 years from now, but you'll get a total of $150,000 from now till then. That's considered undiscounted because you're not taking present value into account. The discounted cash flows were determined to be $140,000. The discounted cash flows will always be less than the undiscounted cash flows. Why? Because we're saying $140,000 is what this $150,000 of cash flows is worth today. It's not worth $150,000 today because we got to wait years to get it all. But if you want to know what it's worth today, it's worth $140,000. So determine the impairment loss under U.S. GAAP for the year. And you need to know that U.S. GAAP impairment testing is a two-step process. The first step compares the asset's carrying value of $180,000 to the undiscounted cash flows of $150,000. And since the undiscounted cash flows are lower than the carrying amount, the asset is determined to be impaired. Right? Since you're only going to get $150,000 of cash flow from this asset and you're carrying it on your books for $180,000, it looks like it's impaired. Now that was step 1 of the two-step test. Determine whether the asset is impaired. And to do that, we compared the carrying amount of $180,000 to the undiscounted cash flows of $150,000, and we said yes, the asset's impaired. Now if we only did the first step, we would think that the impairment was $30,000. But there's a second step. Once you determine that the asset's impaired, now you got to get real conservative to determine the actual amount of impairment to take the bigger loss, and we would have a bigger loss than $30,000 if we use the discounted cash flows to then compare to the carrying amount. If we compared 140 to 180, we'd wind up with a $40,000 impairment loss. So once we determine that we have an impairment, then we go to the second step, which gives us the more conservative impairment loss of $40,000. Letter C is the answer. And this kind of question's on the exam all the time, where a lot of candidates get tripped up because they think the answer is $30,000. No, we did use the $150,000, the undiscounted cash flows, to compare to the carrying amount to see whether we had an impairment or not. But once we knew we had one, then we jumped to the discounted cash flows to make that loss larger, and we compare it again to the carrying amount. Notice we didn't use the historical cost at all. That's just extra information. The exam's famous for giving you useless information, and that's why you got to get familiar enough with the questions so that you can anticipate the useless information and even anticipate the next question that they might ask with this same set of facts. All right, let's change one thing about the facts, and let's see if we can answer the question. We still want to know the impairment loss under US GAAP for the year, but look what changed. They still have a machine with a historical cost of $200,000. This time the carrying amount at year end is $130,000, not $180,000 like it was before. At year end, the undiscounted cash flows were determined to be $150,000. So step one, you'd compare the carrying amount of $130,000 with the undiscounted cash flows of $150,000, and you wouldn't have any impairment because you're going to get more cash from this asset than you're carrying it on your books for. So you don't have any problem with an impairment here. And as soon as you determine that there's no impairment, you don't even have to look at the discounted cash flows. Doesn't matter what they are. Even if they were less than $130,000, wouldn't matter because there is no impairment when you compare in step one of the test the $130,000 carrying amount to the undiscounted cash flows of $150,000, no impairment. The answer to this question would be A, 0. And that's what I want to do here is change one more thing. We got Belt Corp has the machine with the historical cost of $200,000. We said the carrying amount at year end is $130,000. At year end, the undiscounted cash flows were determined to be $150,000, so we know that we don't have an impairment problem because we're going to eventually receive more cash than the carrying amount, so no impairment. But look at this, the discounted cash flows were determined to be $120,000, less than the carrying amount. But we never compare the carrying amount of $130,000 to the discounted cash flows of $120,000 because we do step one first and we compare the carrying amount of $130,000 to the undiscounted cash flows of $150,000, and we find that there is no impairment. And if there is no impairment, there's no step two. So it doesn't matter what the discounted cash flows are. So the answer once again is A, 0 impairment. And this is considered a basic question on the CPA FAR exam, on the exam all the time. And one of the reasons the I-75 course is so successful is that you learn to anticipate the next question that you're going to see based on the question that we just went over. It's not the question that you just finished. You're not going to see that exact question. It's what question am I going to see on the exam based on the one I just answered. Because let me tell you what the AICPA is going to do. They're going to take the question that you've seen, the ones that they've released, and they're going to change one amount here, one number there, add some additional meaningless information just to try to distract you and dare you to answer it. And if you're already doing that, taking a question that you've already seen and changing one amount and trying to answer it, then you're thinking the way that the AICPA does. And that has to be a good thing for you. All right, here's another basic question, this time in the area of government accounting. It says in the general fund, how much expenditures should be recorded for the fiscal year? So let's read the facts. For the fiscal year, the town of Bel Air's general fund had appropriations of $2 million. That means they're legally allowed to spend $2 million. But here's what they spent. They bought school buses for $1.4 million. They paid salaries to the school teachers of $500,000. So they spent $1.9 million, and they want to know how much of that qualifies as expenditures in the general fund. And expenditures for government accounting is really anything that you spend money on that's not expected to produce revenue. For example, the school buses of $1.4 million are not expected to produce revenue for the town because they don't charge the kids for getting on the bus or going to school. So that $1.4 million is just an expenditure. Like anything else, it gets charged against the budget, right? They get $2 million to spend. This $1.4 million is just as much of an expenditure as this $500,000 payment salary to the school teachers, because that's not expected to generate any revenue for the town either. So the answer would be $1.9 million, which is letter C. So you'd have to know that the general fund uses modified accrual accounting. So that means they're not going to pick up these school buses as assets, nor will they depreciate them. Instead, they'll just charge them off as an expenditure, $1.4 million, just like the $500,000 salaries to the school teachers, which brings the expenditures to $1.9 million. Most candidates would get this wrong because they would put the $500,000 into an expenditure and they would think that the $1.4 million maybe would be capitalized, but it isn't, because under modified accrual accounting, only current assets and current liabilities go on the balance sheet. A big ticket item like a school bus, you would not capitalize that. Why? Because it's not expected to generate revenue for the town any more than if they would buy a new fire truck or a new police car. It would just be an expenditure. The only place this school bus would show up as an asset would be in the government-wide financial statements, not in the general fund's financial statement.
Is passing the CPA exam harder than doing a backflip? Well, the answer is it's all about preparation.
Hi, I'm Darius Clark, and here at I-75 CPA Review, I'm going to put you on the right road. So when you go to take FAR, Audit, BEC, and Reg, you're going to have so much confidence, you're going to be like this guy doing a backflip. So go to CPAexamtutoring.com and take I-75 to your next pass. Because the only thing more painful than failing the CPA exam is failing a backflip. So for just $109 a month, become a monthly subscriber to I-75 CPA Review and get all 4 parts for the same subscription.